the most awarded SUV ever.
Let's start with Tamara on the line in Etobicoke, Ontario. Hi, Tamara.
Oh, hi. Thanks very much for taking my call. I wanted to ask about H&R REIT. If this is a good time to get in now, considering that what I'm hearing is that the Canadian real estate market is softening, is this REIT affected by it as well as other REITs? Thanks very much.
Sure. So, Tamara, let's talk a little bit about your question. There's a couple of parts to it. First of all, is it a good time to take a look at H&R or REITs in general? And REITs have been a big component of our portfolios. A lot of the money we manage is for yield-driven portfolios. And REITs have done really, really well. Over the last few weeks, REITs have been consolidating some of the gains they've had from earlier in the year, while people have been jumped on sort of the risk bandwagon. We think that this is a theme. The real estate theme is one that will continue for quite some time because you're going to get nice dividend growth. When you look specifically at the REIT market, there's a number of different camps. H&R is in AAA office space. And the office market in Canada has very high occupancy. H&R has a significant exposure in Calgary. It's got good, strong exposure in Toronto. And specifically, you know, their occupancy levels are very high. So when you talk about real estate being a little bit soft, I think more there's discussion around the housing market and even more specifically the condo market. So they really shouldn't be impacted by that. The only thing that would be a cause for concern is if you believed that long-term rates were going to rise, and that would make a bit of a headwind for the REITs. We are not in that camp at this point. So we think that you're getting paid roughly 4% better than you'd get in a Canada bond to buy most of the major REITs. That's a pretty good risk premium. You get a little bit of dividend growth. The little pullback over the last little while probably provides a good entry point. If you really think that the economy is going to catch fire here, then maybe there's other spaces that'll do a little better. We prefer to stick in the camp where we're getting paid, we see a little dividend growth, and we don't have tons of economic exposure currently.
And have you trimmed some of your positions in the REITs?
We really haven't. The only thing that we've done in our income portfolios is we've reduced a little bit of pure utilities exposure in favor of energy and specifically the dividend payers because that gives us a little bit more sensitivity to energy prices. But no, the REITs have been a big exposure for us. The other thing we have done is we've added a little bit of U.S. REIT exposure, which are a little more economically sensitive than the Canadian ones.
Boston Properties?
Boston Properties, Kimco, which is in the retail REITs. They're more like developers and less like landlords. And so for some portion of the REIT exposure, you know, they continue to make new highs.
All right. Jim's in Massey, Ontario with a question. Hi, Jim.
Hi, Mark. David, I got a two-part question. I know you do stop losses on stocks. Royal Bank, what would be your stop loss, and why don't you use a put option? It would cost you money to protect your stuff on the downside. Thank you.
Well, certainly, you know, puts are an option. You do pay for that, and so we haven't tended to use puts. On the Royal Bank, I think as long as you saw it staying above the 200-day moving average, which is somewhere around $54, something like that, I think that we're okay. We are not big holders of Canadian banks. They're performing all right. The relative strength versus the market itself is a little weaker than the market. But Royal Bank is one of the better performers, and I don't think you're going to get hurt too badly. I just wouldn't expect it to take off like a rocket here.
And sorry, just to be clear, you own which of the Canadian banks?
We own some Royal, we own a little bit of Commerce, and we own a little bit of TD and a little bit of Scotia, but it's quite a small weight in our portfolios.
Right. Okay, an email now from Sylvia in Kincardine, Ontario on Visa. May I please have your opinion on this one and your analysis? What is the growth potential for this company compared to MasterCard? Okay, so we quite like Visa. It's a holding that we have in our portfolio. When it comes to financials, this is one of the companies that we own. And it's, you know, we talked at the beginning about wanting to take advantage of a sort of consumer long-term themes, and certainly the card companies have a benefit here. The debit card is doing okay. Credit cards are obviously doing well. Visa's in a particularly good position to benefit from the electronic wallet
that's coming. You know, very, very soon we'll be using our BlackBerries and iPhones to make payments. And Visa has very good infrastructure for that. So they could be a big beneficiary there, and they've got global growth on their side. So this should be a pretty steady performer.
Okay, so that's a take on Visa. Here's Bruce. He's in Toronto. Go ahead.
Oh, good evening, Mark. David. David, I'm thinking about tax loss season, and I'd like you to tell me, if you will, when does that officially start and end? I'm thinking of going into either Manulife or Power Financial. Which would you choose, if either?
Okay.
Thank you.
So, Bruce, that's a two-part question. Tax loss selling will start to come over the next few weeks, and you can expect to see it take place through into December. And certainly in the case of the life insurance companies, you know, these are companies that will, you know, could get impacted. The big driver for Manulife and for Power, Manulife specifically, are, you know, the behavior of markets. They do get impacted by equity markets. We are cautiously optimistic in that in the short run we think markets are okay. We do think that there are some risks later in the fall for equities. And then the other question is what you think is going to happen with long-term interest rates. And if you think long-term interest rates are going to stay low, it's challenging for the life insurers. The main reason people would invest, or one of the reasons they'd invest in Manulife, is for their Asian growth, which is attractive, and it will make up a big part of their earnings as time goes by. But of course, Asia's, you know, having some difficulties right now. I think given the tax loss season, we're not bottom fishers. We don't tend to buy stocks that are really beaten up. I think that there are some better sectors to focus on than the insurers based on outlook for markets, both equity and debt. So I think I would steer clear of both of them currently. But for value investors who do bottom fish, tax loss selling season would be a time to do it. It's just not our strategy.
It's not your strategy because you like to go with what's moving and what's working, what has momentum.
Yeah, I think that many people in our business focus on doing what they think will do well in the future, which, you know, you can be really wrong on. And we've spent a lot of time using tools to try and identify what is working today and focus in those areas until that changes. And we're just not at the point where we can say that, you know, life insurers are coming out as leadership in the market.
Mm-hmm. Okay, David, a short break. We'll come right back. North American large caps, that is the topic. We'll get back to you with your questions after this.